So I want to start by talking about U.S. money supply, which has gone up more in 2 weeks. That's over 700 billion to be exact, than in the 6 weeks during the pandemic. It's the most aggressive we've seen in U.S. history. So Jim, why is no one challenging the Fed about this?
Well, the main reason, Danielle, is people don't understand the Fed. They don't understand monetary policy. And by the way, the elites like it that way just fine. The average American probably thinks Federal Reserve is a brand of, aged whiskey or something. So, look, you understand it. I understand it. The Board of Governors understand it. Actually, they don't. They're not very good at what they do. But there's some experts and analysts and some members of Congress who do. But that's about it. This is not. The creation of money is one of the great mysteries. It's actually not that big a mystery, except it is because people don't know how it works. So they're not held to account. They're also technically independent agency. The regional Federal Reserve banks in the U.S. are privately owned. They're owned by banks in the area. If you said, who owns the Fed? I would say Bank of America, Citi, Wells Fargo, and JP Morgan, and a bunch of other banks. The Board of Governors are appointed by the president, but there's actually a vacancy at the moment. That's more inside baseball. So that's the problem. It's not well understood. Now, for those who do understand it, they have increased the money supply radically, but it really doesn't matter very much at this point because there's no velocity, there's no turnover of money. We can talk more about that. The Austrian economists, the neo-Keynesians, the monetarists, they all agree on one thing: that's if you create money, you're going to get inflation. An increase in money supply will be an increase in prices, et cetera. That's not true. It's empirically not true. Just go back to 2008. In 2008, the Federal Reserve balance sheet was $800 billion. Today, it's about $7.5 trillion. Even as late as 2015, it was $4.5 trillion. Where's the inflation? We don't have it. So that means that money supply does not correlate to inflation. The key to inflation is a serious problem, or will be, but the key to inflation is not money supply, it's velocity. It's the turnover of money. And the problem right now, are they creating money? Yeah, they're creating it like crazy.
Right.
But all they do is they give it to the banks to buy treasury notes. That's how they increase the money supply. They stick the treasury notes on the Fed balance sheet and they just sit there. The banks have the money. What do they do with the money? They give it back to the Fed in the form of excess reserves, and they get a little bit of interest on it. But the money doesn't go anywhere. It's the lending, the spending, the increase in basically the turnover of money that could give you inflation, but we don't have that. Why? Because people are scared. They're, if you lost your job or your business shut down, you're not spending. You're either paying down debt, you're paying bills. But when you pay bills, that's not spending. That's just reducing your balance sheet. Spending is like going out and buying dinner or Christmas presents or a new car or something. People are not doing that with very few exceptions. So, and the banks aren't really willing lenders at this stage, except to certain sectors. So you're not getting lending and spending, you're not getting the turnover, and therefore you're not getting the inflation. The money is just piling up and it's not going anywhere. So for now, the increase in the money supply doesn't mean anything. That could change, but we have to watch for that.
But Jim, I'm sure a lot of comments will come in saying, Jim, Rickards, have you not gone out grocery shopping lately? How could you say inflation isn't here yet? Are you speaking about inflation amongst all sectors here, or?
Well, but that's how the Fed measures inflation. That's how economists measure inflation. So, okay, grocery prices may be up. I don't dispute that, but TV sets, computers, laptops, prices are going down. Tuition is actually going down, believe it or not, after going sort of straight up for 30 years. So you can't just look at a quart of milk. Yeah, if you're out to buy a quart of milk, you might notice the price went up. But when you look at everything else, clothing, I mean, they're practically giving it away. And that is how they compute CPI. As you know, it's a basket, and it's got groceries, but it's also got clothing. Gasoline at the pump is going down. So people, psychologically, people tend to dwell on the number of prices that they see going up, and they ignore the price decreases. But again, clothing's a big item. It's, as I said, they're practically giving it away.
If you say we're not going to feel the repercussions of the money supply yet, how about other asset classes like gold? Would it get a bounce here because of this increase in money supply?
Well, gold is getting a bounce, but it's getting a bounce for other reasons. First of all, you're right about gold, Danielle. It's when people say, is the dollar going up or the dollar going down? They look at the euro US dollar cross rate, or they look at the dollar yen cross rate, et cetera. And I tell people those measures are meaningless because, yeah, if you're in the export-import business, you care about the foreign exchange rate. But all the major currencies, the 7 or 8 major currencies that make up the IMF Global Reserve Report, they're all passengers in a lifeboat. They're all survivors in a lifeboat. Some may be taller, some may be smarter, whatever, but they're all in the same boat. They're all going to sink or survive together. The only way you can understand what's going on in currencies is compare it to gold. And so when the dollar price of gold goes up, I just say, well, that means gold doesn't change. It's atomic number 79. It's an element. It's the same thing. If the dollar price of gold is going up, that means the dollar is getting weaker. If the dollar price is going down, that means the dollar is getting stronger. So if you want to forecast gold prices, you have to ask yourself, is the dollar getting stronger or weaker? And then that's a pretty good basis for making a forecast. But the difference between gold and all the other currencies is gold, of course, is the only one not printed by a central bank, not subject to manipulation as the supply. There is new supply, but new supply has been static at about 300 metric tons per year for the last 5 years. So that's not expanding dramatically. And that's it's about a 1.6% increase on the global above ground supply. So that's not a big number either. So, but gold is your thermometer to tell if the patient is sick or not, the patient being the dollar.
What about JP Morgan's recent report coming out saying that Bitcoin is in fact hurting gold right now? We've seen, tremendous inflows in Bitcoin ETFs and major outflows out of gold ETFs.
Yeah, the gold Bitcoin comparison is a straw man. It doesn't mean anything. That's typical Wall Street research, which I pretty much ignore. I look at good research, but I don't put Wall Street in that category. Here's the thing. Bitcoin and gold are both going up because of concerns because of loss of confidence in the dollar. So I don't see a Bitcoin gold trade-off. I mean, first of all, the numbers don't add up. The total market cap, I understand that Bitcoin in percentage terms has had a great run in 2020. It's gone from about $9,000 to $20,000. That's a 100% increase. I get that, but the entire market cap of Bitcoin, if you took all the Bitcoins in the world times $20,000, it's not that much. It's certainly tiny compared to gold, and gold is tiny compared to the foreign exchange market. So there's no. It's not like a zero-sum game and people are getting out of gold and they're going into Bitcoin. That's not happening. What is happening is that people are getting into gold and into Bitcoin at the same time because they want to get out of the dollar.